Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, going to go through some information. I'm going to give you my financial opinions on there. We're going to talk a little bit about oil, a little bit about copper, maybe some other random things as we go through it about the stock market and commodities markets. Again, if you want to follow me, you can follow me at finding_finance, and we'll get right into it. So I think this is funny. He says, I have a dream that Biden announces an SPR release and oil moons. So I've got another one underneath this about Biden releasing some more oil from the SPR. I think it comes between April or March and May of this year, March and May. But I just thought it was funny because, I think they're kind of panicking. Maybe it has something to do with the consumer price index that's being released, the number tomorrow. I don't know. But yeah, that announcement has come out. Here's one that says there isn't enough copper in the world, and the shortage could last till 2030. So I clicked on this article. I just want to touch on some highlights here for everybody. So let's zoom way in on it. So it says a copper deficit is set to inundate global markets throughout 2023, fueled by increasing challenged South American supply streams and higher demand pressures. Copper is a leading pulse check for economic health, and the red metal squeeze could be an indicator that global inflationary pressures could worsen and subsequently compel central banks to maintain their hawkish stances for longer. So if we were to scroll on down here, let me go out one. So a copper deficit is set to inundate global markets throughout 2023, and one analyst predicts the shortfall could potentially extend throughout the rest of the decade. And that's what we've been talking about with a lot of these metals. 2020s will have a deficit of a lot of different metals, and this one happens to be copper. It says the world is facing a global copper shortage fueled by increasingly challenging supply streams in South America and higher demand pressures. A copper squeeze could also be an indicator that global inflationary pressures will worsen and subsequently compel central banks to maintain their hawkish stance for longer. It says we're already forecasting major deficits in copper to 2030, says Wood Mackenzie's vice president. He attributed it largely to ongoing unrest in Peru and higher demand for copper in the energy transition industry. Anytime there's political unrest, it has a whole range of effects. We come on down. Peru accounts for 10% of global copper supply. Additionally, Chile, the world's largest copper producer, which accounts for almost 30% of global supply, recorded a year-on-year decline of 7% in November. So we've got problems in Peru, and our biggest producer of Chile had a decline of 7% in November, which is 27% of global supply. It says overall, we believe Chile will likely produce less copper from 2023 to 2025. Says Goldman Sachs. It's typical to see disruptions, and I don't think we're necessarily seeing any more than normal. That's the managing director at Wolf Research. We've got coping with copper consumption. Says the reopening of China and growth in the automotive and energy transition industries have stoked demand. China's reopening has a major impact on copper's price as this improves demand outlook and will push copper prices even higher due to the supply shortage on the back of a clean energy transition, which makes mining harder. It says the deficit may last till a potential global economic recession caused by the current headwinds by 2024 to 2025. And that lines up kind of where things could turn. It says forecasting that by then, copper prices might double in price. It says copper consumption in particular really didn't slow down in 2022. Factories were still running, government stimulus, and infrastructure was still chugging along, she explained. It says you can't see electric vehicles take off before you get the charging infrastructure, and the electrification which is necessary is actually much more copper intensive. There's also, I'm not reading this, but there's also another thing here. If they can't get electric vehicles to take off, what do you think all these people are going to do? They're going to burn oil. They're going to burn gasoline and diesel and use oil. So the copper shortage is going to put more pressure on demand for gasoline, diesel, and the existing cars that we're using. Sales of electric cars in 2021 more than doubled to bring the total number of EVs in the world around 16.5 million. Says there's a longer term issue around the supply of copper in the energy transition because the growth in both the automotive and transmission is going to be huge. And if there is shortages there and it slows that adoption rate down, we're going to use more gasoline, more diesel, more oil at a faster pace than what I think most people are realizing. Now, here's a chart breakdown of NASDAQ, the big picture, return to normal phase of super bubble. Sometimes you just need to gain a real perspective on how truly ridiculous / overpriced the situation is. So we had a big move in the 90s, 2000 bubble here. We went into that. It's really a double bottom here. It's bottom one, bottom two. You draw a line across here. We had that pause on the right-hand side of that double bottom. This here is that pattern that we're seeing in all of commodities is the bottom here. This is the double bottom, and we're right in this location for a lot of the commodities right here. Some of them are down a little bit, like the dry bulk shipping. Some, like copper, are starting to come up already. We've got rare earth metals in this section right on the right-hand side there. We've got a lot of oil and natural gas, depending on what they are. They're actually putting in a little bit different bottoming patterns. I would say they're putting in inverted head and shoulders for the most part. But commodities are all in this section here. Looking at the NASDAQ, totally different. It already had its massive run. The big run here, we're starting to come back down. This is basically the top of the market. We come back down, we'll have one big surge higher here. Now, we don't know where this surge is necessarily going to go. It could be right where the circle's at. It could come back and do a double top. It could come back and do something that's like 14,500. It doesn't have, it could be anywhere in here. This chart is the same chart as basically a lot of the cryptocurrencies, Bitcoin and all those other ones. And the pricing of the NASDAQ is highly dependent on interest rates and the market conditions. When house prices go up and you get a credit expansion in the system, the increasing interest rate that comes with it generally brings down the valuation of growth stocks in the NASDAQ. So that is why this is going down. It's not a crash from credit deleveraging. It is a crash from a revaluation due to increasing interest rates, which is much different than a crash from the housing market and credit deleveraging. Two different scenarios there. So we can see this go down with an accompanying commodity increase with copper, oil, and all the other commodities. This is the CPI number. I know we're releasing numbers today. It's going to be Tuesday. So CPI number will be released Tuesday. The S&P 500 has rallied on each of the last 4 CPI release days with an average gain of 2.3%. What will tomorrow bring? So if you look at this, you can see the SPX reaction and the CPI actual versus the CPI forecast. They've been a little bit lower than the forecast the last couple of times, and you can see that these have gone up a bunch from that. So, and really, I think what it's pricing in is the CPI actual. It came all the way up to 9.1, and then it's been declining ever since. And that's been a positive, generally a positive for the S&P 500. The only one that was a negative is this guy that was a little bit higher than the 8.1. So the actual came in higher than the forecast. But all the other ones, since they've been declining here, has been positive reactions. So if it is lower, and I don't know what it'll be tomorrow, if it's lower than 6.2, we're going to get a positive reaction, I think, out of the S&P 500. If it is substantially higher, like a 7 or something like that, or a 6.8, or even a 6.5 maybe, we might see a decline in the S&P 500 as that gets priced in. So that is one thing to watch for tomorrow, and we'll see if those those numbers that I said are actually right, because those are just kind of estimates. Now here's Dave Kranzler. He says, potential move-up buyers, this is about the housing market. Potential move-up buyers can't afford to move up, so they have to stay put. Well, I wouldn't say that's necessarily the case, but there will be a glut at the high end, plus there's a massive blob of homes in the home builder WIP inventory that will flood the market. But if you look at what the actual data is instead of the opinions, so here's the data. And so looking at the data, we've got new listings, new list immediate sales, 58,000 new listings, 13% fewer than last year. So your total listings here, this is new listings here and new list immediate sales. So we're seeing that the actual immediate sales, which is the pinkish line, there isn't that much new homes to be sold in terms of weekly new inventory. Now, we understand that there's a bunch of new listings, but that isn't what is immediately available to buy. So new list immediate sales are these guys here. So yeah, I still think that the market is tight, and there is a large divide amongst who's out there. So again, it says you can see the supply-demand story play out in the price reductions data too. 32.2% of the homes on the market have taken a price cut recently. Look at how quickly the market is recovering, the dark red line, from last year's dramatic slowdown, the light red line. So this is the light red line in 2022. You can see how this is coming down, and we'll call it the rate of change as this comes back down, but we're starting to really kind of slow that rate of change down with fewer price reductions. We were up over 40%, but we're starting to come back around. And if you notice on earlier years that we kind of come down here and then we start to come back up over time. So this will cycle over time in that cycle looking thing. It says the pendings count is recovering rapidly. 291,000 single-family homes are in contract pending stage now. The autumn slow sales gap is closing. A few weeks ago, we had 30% fewer contracts pending than last year. Now it's 23% fewer. Newly pending is only 9% fewer. So the housing market is kicking back up, and we can see that in the data here. And that's basically what that data is telling us. It says supply is tight, demand is okay, prices are holding up, even with obvious affordability challenges. Median price of single-family homes in the U.S. this week is $418,200, slowly ticking up as expected for quarter one. You can see this tick up here in home prices. The leading indicators point to flat home price appreciation for 2023. So here's our seasonality that I talked about before. Each year you get this kind of run up into the summer, and then it slowly declines and really kind of tails off right before January. Then that cycle repeats, and that's that stair-stepping pattern that I talk about. And you can see that we are still heading higher. This doesn't actually look like a major crash. What we saw was what we'll call it an over-exaggeration of seasonality this year with this big pullback. But that seasonality exists every single year. And I'm gonna refrain from any sort of projections or anything and just say, look, let's watch what this does over time. And I think that we're going to see a move higher in home prices or a flat home price. And a lot of it does deal with the high interest rates. I understand that. It says all those details are in this week's Altos Research real estate market video. Home buyers are defying expectations. So that is something that you can check out. Here's another one. It says another month, another OPEC plus production miss. Total production for OPEC plus countries, excluding the OPEC exempt, was 38.31, falling short of the 40.1 quota by 1.8 million barrels per day. So I don't know if they're tapped out. I don't know if they're purposefully holding back production. I think they're pretty much tapped out, is my opinion on it. And they're still missing quotas. And here's another one. It says another week, another U.S. gasoline demand increase. So according to Gas Buddy data, weekly U.S. gasoline demand rose 1.7% from the prior week and was 3.7% above the 4-week moving average. We model consumption at 8.45 million barrels per day. So that's gasoline demand is remaining robust. We've got stocks do best when unemployment is high. So what he's talking about here, and if we were to look at this, unemployment goes down because the housing market and new home sales generally are a large driver of job creation. So under a big expansionary phase with high inflation, generally what you see is you see a decline in unemployment rate down. So you go downward, and the returns of the S&P 500 or stocks goes down during that time frame. You eventually hit a peak, unemployment starts going up, your housing starts go down, they start laying people off because there's a housing glut. They go through a crash, unemployment goes up, and interest rates get pulled lower. And the lowering of those interest rates is what reprices the S&P 500 higher, because more people, they can't get a return in bonds, so they go and they speculate in the stock market, and money starts to flow in the stock market. So if you were to look at the unemployment rate, and you could even do this if you want to, you could plot the unemployment rate, look at the valuation of the stock market and commodity market, and when this is declining, as long as commodities are well priced, you're going to get a commodity boom. So we are getting a commodity boom as we come back down. Then when this reverses and we have a large glut of homes built and we go into a hyper supply phase, this is going to go into a recession. We'll cycle back down when the unemployment rate goes up and interest rates fall down, and that will get you a return in the S&P 500 as money shifts and prefers to be in stocks as commodities crash and the demand for commodities crash and interest rates are lowered, increasing the return on the S&P 500. So there's that. So here's one, and this is the bond prices. And I'll just say this for a second. Bond prices go down when interest rates go up. And this chart feeds into this chart, which feeds into all the other data. So it's posted on a blue false breakout back in March of 2020 in real time, then on the blue 20-year trend line. So this is the bond prices for the 20-year US bonds. TLT is the ticker. We're coming on up. What he's got here is a potential shoulder, head, and then a shoulder that comes up and comes back down for bond prices, and this doesn't have to go all the way up. It could return right where it's at. It could do all sorts of things, but it could come back up and then come back down in bond prices. What this is telling us is that over time, if bond prices decline, and that's what this chart is suggesting, it means that interest rates are going up. It means that the stock market's going to decline, just like we saw in the NASDAQ earlier in this video, and how that was coming and crashing down, and how this could come up. Lower interest rates will push bond prices higher, means there's a demand for bonds, and it's going to push the NASDAQ up, like we saw in that other chart. It's going to scribe out another shoulder here, which is going to be positive for commodities, because commodities, I think, will run when this comes back down to some extent. It'll definitely run up. It may run up a little bit after, and then if it's the big boy crash, when you get below maybe this purple line here, the big boy crash, that's when you might have to start looking to exit maybe even commodities for a short period of time, or raise a little bit of cash or something like that. But that's a ways out. That's out in 2025 or 6 or 7 or something. It's going to take some time. Here's another one. This says, this is the largest valid bullish rising wedge I've ever seen. Note how it's been backtesting the closing high at 1673 from 2012 during the last 2 years. Digesting the up move from 2016. So what he's talking about is this is gold. We had a break here. That's a big break of this resistance line looking backwards. It came on up. So now we've got another resistance line that we created at 1673. So we look at that 1673, we come back over, and we're coming and basically resting on top of that support level. So we broke out above, we're coming back and resting, we're coming back to a trend line. Then we've got another trend line up here, which is a rising bullish wedge formation. And the reason it's bullish is because we're under the right market conditions for gold to move higher. These are generally very powerful moves when they break out of this wedge. And remember interest rates, because this all ties together, guys. Interest rates have broken a 40-year downtrend in interest rates. Bond prices are going to go down just like I showed you before. So I'm just going to go back and show you some stuff. If bond prices go down here like that, and we've got the NASDAQ in a gigantic bubble that's also going to go down, what that means is that money is going to rotate out of those two assets. It's going to rotate out of the bond market and out of also the NASDAQ and some of the stock markets. What that's going to do is that money's going to have to look for a new place to hide. It's going to transfer into GOLD, gold, physical gold, maybe some of the precious metals mining companies. This is going to be much like the 1970s or 40s or 50s. Gold didn't trade freely in the 40s, 50s, and 60s. It did in the 70s, and that's why I refer to the 70s. But we're going to see a breakout of a gigantic pattern to the upside eventually, and a very big move. Money's going to rotate out of bonds and out of stocks simultaneously and move into something new like gold and commodities. That's the reason this is in a pattern here, and the 2000 bull market was not the big boy move. That was stuck inside of a downtrend of a declining interest rate environment. What's coming is we've got the breakout of the 40-year plus interest rate environment, and that breakout of the interest rate is going to force that rotation of money out of bonds and out of stocks, out of both of those assets into this, driving it out of a gigantic pattern like this. This is massively bullish. Massively bullish. Haven't seen that since the 1970s. Now here's one that says, Oil Guru, it says, it is our understanding that Russia may be starting to encounter difficulty maintaining output at technically challenging fields due to initial US and EU sanctions that prohibit the transfer of key technology and equipment to the Russian energy industry. So they are experiencing some difficulties with their production. We've got U.S. to sell 26 million more barrels from the Strategic Crude Reserve. New U.S. strategic crude oil sales were mandated by Congress. Delivery for new U.S. SPR sales expected between April and June. And here's something else. I thought we were supposed to be refilling the SPR. I thought that's what people were talking about. And they were like, oh, it's going to refill at, was it like $60 or $70? I don't know if we're going lower, guys. There's a reason they're going to release this onto the markets, because they think oil prices are going to go higher. We're breaking to the upside. So it's going to be interesting to see what happens here. And I don't think it's going to do much of an impact with 26 million barrels. It's going to have an impact. It's going to slow things down a little bit, but I don't think it will stop the move in oil. This is from Scott. This is URA versus Apple's chart. You can see the fractal comparison that he has. This is the lead-in pattern. This lead-in pattern is a Jesse Livermore accumulation cylinder. If you were to kind of draw it out like this, and then we've already broken the downtrend line here, and I think we're going to move on higher over time. It's going to continue to grind on up. So get ready, guys. Get ready for the move. Here's Happy Wine. He is a, I don't know, semi-bull maybe, or maybe he's just neutral on the markets for housing. It says, but I was told there's a housing glut. Now, this is a different way of viewing this. This is the total inventory homes for sale of the U.S. single family. It's going down. Wait, what's going on? I thought we were in a housing glut and this is going to go back up. And it depends on how the way that you look at these markets, the paradigm or the outlook. If you look at the increase from the bottom, you're going to get these gigantic percent increases year over year. But what if you look at the percent decline of 2019 or 2016 or 2015, which these areas are still very low inventory areas. So he said 46% fewer homes on the market than in 2019. So he just kind of said it differently, because everyone says, oh, it's a 100% or 200% increase from the bottom when we had no homes. So it's like, well, duh. I mean, you had no homes in inventory at that time. So obviously it highly depends on where your start point is. And he's already taking this is a low inventory number. It's not a high inventory number. And comparing it to that. Here's Shabam. It's after unwinding their cuts through the first 10 months of 2022, OPEC crude exports have now dropped off and, more importantly, flat on a year-over-year basis. Oil demand is resiliently growing, inventories continue to be relatively low, and supply response remains extremely muted. Perfect. And this is more about the global observable total petroleum inventories. And here's our inventories declining. Go all the way down. Now, we are flattening out a little bit down here. And this is generally when we build, though. So if you look at kind of the beginning of these months, like 2012, we had a build here. 2014, like right here, we get a little bit of a build. You usually build in some of these areas. We're not really building much inventory. We just keep going down to some extent. This is the deviation. You can see it coming down and down and down and drawing down barrels all over the place for global observable inventories. It says, fully expect this again for 2020s. Another great chart from Tavi. The trick, though, probably still up for stocks nominally in the 2020s, but in real terms, significant decline. It says the U.S. stock market suffered significant multiple contractions during prior inflationary decades. The CAPE ratio declined by an average of 50% in the 10s, 40s, and 70s. Today's valuations are too high for how elevated cost of capital is with no real growth. And these are the declines during the 40s, 70s, and 10s. And I think that the similar market conditions are here in the 2020s, and we're going to see a decline in U.S. stocks with a compression in the price to earnings ratio. Now, here's another more information. So the falling energy return on investment of the primary silver mining industry, with Fresnillo's silver mines now processing nearly 4 times the ore to produce 6 million ounces more silver than in 2005. This costs an arm and a leg and a foot, just the facts. So this is the total milled ore, Fresnillo. So this is Fresnillo Sociedad. So you can see that we are coming down in the million of ounces produced. And then the million tons of ore is the red on here. And you can see that we are coming up, or we're remaining quite high here, even though we're seeing a decline in the million of ounces of production. Declining production, the ores are basically flat in terms of the total milled ore. And that's your ore grade declining. So as ore grade declines, you have to move more material to get less output, which is great for if you're an energy investor, because they're going to suck down the energy. That's for sure. I do like this quote a bunch because it's right. It says, the causes of all panics, crashes, and depressions can be summed up in only 4 words: the misuse of credit. And that misuse and or misallocation, or the credit that goes to people that shouldn't have it, and later on gets destroyed, that is where crashes and depressions come from. Completely agree. And the main driver is generally the housing market. That's the main driver. We'll end it there, guys. That's what I've got for today. Hopefully you've learned quite a bit about where we are in this cycle. I think that we are still in a housing market boom. We are still have an increasing interest rate environment. It's going to put pressure on the stock markets, going to put pressure on the S&P 500, the NASDAQ, and bond markets. That money is going to rotate over, and we've got positive signals and chart patterns in gold and commodities. That's where we're at. And it could last a good long while, guys. 5, 10 years, maybe even longer. It depends how long it takes to fix the supply issues, and it depends on how long the credit is kind of fueling it in the system. And we're also at the end of a credit cycle, which could also fuel money out of bonds if people get scared and rotate into precious metals and other commodities. All right, guys, give me a thumb up for the content. Subscribe to the channel if you haven't. If you guys are interested in commodities and all that, definitely look at finding-value.com. Become a platinum member. Join our community. Love to have you there. And we do have a platinum question and answer session at 7 a.m. Mountain Standard Time on Saturday. See you there. Thanks for viewing. This is Finding Value.